Hey traders, and welcome back to another video. Today we will talk about order blocks, key zones where some of the most precise trading opportunities can appear. But here's the big question: why do some order blocks work so well, while others get completely ignored by the market? To find the answer, we went through and backtested over 100 order blocks in different market conditions. Our goal was to discover what actually makes an order block more reliable, and whether applying certain rules could increase the win rate. What we found was eye-opening. Order blocks only work consistently when specific patterns repeat themselves in the market. So in this video, here's what we're going to do. First, we'll walk you through the basic setup and the rules we used during our testing. Then, we'll break down the conditions that make an order block more likely to hold, and how you can use them to boost your trading accuracy. If that sounds like something you're into, don't forget to like this video and subscribe to the channel. And if you have any questions, make sure to drop your comments below. I will see you after the intro. Welcome back, traders, and let's start by explaining what is an order block. Order blocks are strategic zones of supply and demand in the market. They are created when central banks or large financial institutions place massive orders, accumulating significant amounts of an asset. This leads to a sharp price movement, causing an imbalance between buyers and sellers. Why are order blocks important? Because when the price returns to these zones, it often reacts strongly, making them valuable for identifying potential trade opportunities. We put this trading strategy to the test by backtesting it 100 times on the Euro-USD pair, using the 1-hour time frame. For the test settings, we started with an account balance of $10,000, risking 2% per trade, and targeting a 4 per profit, giving us a simple 1-to-2 risk to reward ratio. Now, let's take a look at what the results showed. These are the 100 order blocks we identified during the test. Green blocks represent trades that successfully hit the 2-hour profit target. Red blocks are the losing trades where price hit the stop loss. Gray blocks are setups where price never triggered the entry, so we simply skipped or canceled them. Here's how it all added up. 28 trades didn't activate. 41 trades resulted in a loss. 31 trades were winners. That gave us a 43% win rate, with a maximum drawdown of 10%. Despite the win rate being under 50%, the strategy still managed to grow the account by 47%, which is impressive. During this backtest, one thing became very clear. When specific conditions align with order blocks, the chances of success rise significantly. We also began to see recurring patterns on the charts that helped improve overall performance in a big way. So, let's go over the key conditions that help us identify high-quality order blocks. But before we jump in, if you're enjoying the video so far, make sure to hit the like button. It really supports the channel and helps us keep producing these in-depth guides. Also, if you've got any questions, feel free to drop them in the comments. We always do our best to respond to everyone. So, what are the main factors to watch for when trading order blocks? We have grouped all the factors into 4 important categories: market structure, volatility and spread, overall trend, and confirmation from lower time frames. Let's start with the market structure. Take a look at this example. We've identified a valid order block that presents a potential long setup. But if we examine the price action to the left, we can see a clear gap between candles just beneath this order block, along with another valid order block zone lower down. This creates a likely scenario. Price may move down to fill that gap, sweep the liquidity below the first zone, and then bounce off the second order block to continue the upward move. So when we see this kind of pattern, a gap plus another strong order block sitting just below the first, we lower the score or priority of the first zone by 1 point. And just a reminder, if price breaks below the first order block, it doesn't always mean a trend reversal. Quite often, it's just a liquidity grab, a quick move to collect orders before continuing in the intended direction. Now, let's look at a different scenario. And this one works in favor of the order block. In this second pattern, we have another valid order block, but this time, when we look to the left, we can clearly see that price previously swept the liquidity beneath a cluster of equal lows. So when we see that the order block forms right after a sweep of equal highs or lows, we add +1 point to its quality score. It's more likely to hold. The third pattern builds on the same idea. Imagine price is approaching an order block, and just before it gets there, it starts forming a temporary support level. Retail traders often place their stop losses just under these short-term supports, creating a perfect target for smart money to hunt. So what usually happens? Price drops just enough to grab that liquidity below the equal lows and then pushes upward once it hits the actual order block zone. Now, let me show you a real example on the chart. This is the Euro USD on the 1 hour time frame. We've identified a valid order block that caused an inefficient move and a break of structure. But if we look further left, we can also spot a clear support level that held multiple times. That tells us there's likely a lot of liquidity sitting just below it. On top of that, we notice a gap directly under the zone and another valid order block a little lower. This gives us a high probability setup. Price is likely to break below that liquidity, fill the gap, and then reverse from the lower order block, continuing its upward move. Let's walk through another setup. In this case, you could technically consider either of these candles as valid order blocks. We've got a clear gap, a break of structure, plus a mitigated order block. When price breaks below this higher low, some traders might immediately assume it's a change of character, but take a moment to scan to the left. You'll spot another clean gap and a valid unmitigated order block sitting right beneath that level. That gives us a strong clue. What looks like a trend reversal might actually just be a liquidity grab, and the market may still be in bullish territory. Now let's flip it and take a look at a bearish example. Here on the Euro USD 1 hour chart, the market is clearly trending downward. We can identify an order block that caused an inefficient move and a clear break of structure. That already makes it a solid setup. But here's what makes it even more interesting. The initial move that started this entire leg was a liquidity sweep. That tells us smart money likely stepped in at the start. So we give this setup plus 1 point as a high probability trading opportunity. Now let's clarify something important. Not every losing trade means you made a mistake. Even the best setups won't win 100% of the time because the market isn't something we can control. Losses are simply part of the game. Now, let's talk about the second key factor to pay attention to when trading order blocks: market volatility and spread. Looking back at our backtesting data, one pattern was clear. The majority of winning trades happened on high volatility days. In contrast, trades placed on the first or last day of the week, when liquidity is low, were far less reliable. That's why midweek trading, when volume picks up, tends to offer better results. Also, for pairs like EUR USD, timing matters. You'll want to trade during high activity sessions like the London Open or New York session. If you're trading during quiet hours, the market just won't give you the kind of moves you need to make this strategy work. Another crucial detail when trading order blocks, and one that's often overlooked, is how you handle the spread. Many times, price will react to an order block within a single pip, but if you're trading a pair with a wide spread, it can completely throw off your execution. You might miss out on what would have been a perfect entry, or even worse, your stop loss could get hit, even though the real price never touched it. So managing spread is not just a technical detail. It can actually make or break some of your trades. Now, let's move on to the third key factor: market trend direction and the freshness of the order block. Here's what we've observed. Order blocks tend to work much better in trending conditions. In choppy or sideways markets, the success rate drops significantly. That's why it's usually smarter to trade in line with the prevailing trend. When the market is clearly moving up or down, order blocks that align with that direction have a higher probability of holding. Also, how fresh the order block really matters. Recently formed zones tend to be more reliable because market sentiment hasn't shifted much yet. If you're waiting around too long for price to come back and touch an old order block, chances are the dynamic between supply and demand has already changed, making the setup weaker or even irrelevant. Take this example on Euro USD during a strong uptrend. You'll notice the market keeps forming fresh order blocks, tapping into them, and then continuing the bullish momentum. This kind of price action confirms that trading with the trend and focusing on fresh zones significantly increases your chances of success. Now, let's look at a different type of scenario. In this example, we've identified a valid order block zone, but before price even reaches that level, we can see the market forming multiple demand zones and breaking right through them on the way down. Some traders might interpret this as a series of liquidity grabs and place buy orders at the order block. But in reality, what's happening here is that supply is clearly in control. So blindly entering on this order block without confirmation is a risky move that could lead to a loss. If you want more trading lessons, market insights, and live analysis, feel free to join my Telegram channel. It's completely free, and I'll leave the link in the description below. And that brings us to our fourth key factor when trading order blocks: confirmation from lower timeframes. This step can save you from tons of unnecessary losses, especially when price simply disrespects your higher timeframe zone. Having a reliable confirmation method gives you a clear reason to enter and helps you trade with a lot more confidence. The beauty of this strategy is that it's not limited to any specific time frame. Here's how we approach it. Once we identify an order block on the higher time frame, we zoom in, usually 2 time frames lower, and wait for confirmation before pulling the trigger on a trade. This multi-time frame confirmation approach makes sure we're not just reacting to price, but actually aligning our trades with momentum and structure. When we're trading, we typically use the 4-hour, 1-hour, and 15-minute charts as our higher time frames. Then for our entries, we zoom in to 15-minute, 5-minute, and 1-minute charts respectively. You can apply a variety of price action setups to confirm your order blocks, and here are some of the most common patterns we rely on. The first step is waiting for the market to mitigate the order block on the higher time frame, and then watching for price action to give us a clear signal for the next move. One of the key things we look for is a change of character. A change of character marks the end of a short-term downtrend and suggests that the market is ready to shift direction, in this case, likely to the upside. Once we spot this shift, that's when we prepare to execute the trade. Now, in terms of patterns, there are 2 main setups we focus on. The first pattern occurs when the change of character creates an inefficiency that forms a valid order block. In this case, we place our entry just a couple of pips above the order block and set our stop loss a few pips below the lowest point of the zone. To capture larger risk to reward ratios, we use a simple profit-taking technique that allows us to maximize potential profits without feeling too much tension in the trade. If our analysis proves correct and price starts moving in our favor, we'll adjust our stop loss to trail under the market structure. Every time the market makes a new higher low, we'll move our stop loss to lock in profits and allow the trade to run until it reaches a higher time frame supply zone, at which point we'll exit the trade. Now, the second pattern we trade happens when there's a change of character, but we don't see any inefficiency or gaps between the candles. In this case, we use retracement levels to find our entry. We place the retracement tool from the start of the change of character move to the end, and then look to enter a buy position between the 0.61 and 0.78 Fibonacci retracement levels. We set the stop loss a few pips below the swing low, and our target is typically the next level of structure ahead of price. It's important to note that these setups are not restricted to any specific time frame or currency pair. However, it's essential to backtest and identify which pairs perform best with these strategies. And that's it, traders. As I promised at the start of the video, I shared my 4 top order block factors with you. At the end, I also showed you how to use them together in a clear and effective trading strategy. If you got value from this video, smash that like button like you just caught the perfect entry. And if you're new here, hit subscribe so you never miss a move on this trading journey. Thanks for watching, and I'll catch you in the next episode.